When we think about what keeps our banking system in one piece, we usually picture government watchdogs or maybe smart depositors. But today, we're going to dig into some really fascinating research that uncovers a hidden, surprising force keeping banks stable. And it's the very people borrowing money from them. So let's just start with the big question, right? Who's actually out there stopping banks from taking on way too much risk? I mean, it's a huge deal because when banks get into trouble, we all feel it. And the usual answers? They're probably exactly what you're thinking of right now. And yep, here they are, the usual suspects. On one hand, you've got the government regulators. They're the ones setting the big rules. Things like how much cash a bank needs to have on hand. You might have heard of the Basel Accords. That's their territory. On the other hand, you have depositors. That's us. If we think a bank is looking a little shaky, we can just pull our money out. It's a powerful tool often called market discipline. But these two aren't the whole story. See, there's a third group in this equation that's been pretty much overlooked, a group that has this hidden power to shape how a bank behaves. And this right here is the core idea we're exploring today. What if the people and the businesses actually taking out the loans have some power too? What if they aren't just passively taking cash, but are actually, active players in keeping banks in line? So the fancy academic term for this is asset-side market discipline. It sounds a little complex, but the idea is actually super simple. Think about it. A bank's loans are its assets, right? The money it's owed. Its deposits are its liabilities, the money it owes to us. We've always focused on discipline from the liability side, the depositors. This theory flips the script and looks at the power coming from the asset side, from the borrowers. Okay, so why on earth would a borrower care about how healthy their bank is? Well, the research boils it down to two main reasons. First, the simple need to refinance. If you're a business, you need a bank that's going to be there for you tomorrow and the next day. A stable, high-quality bank is a reliable partner. And second, there's this certification idea. Getting a loan from a really solid, reputable bank is like getting a gold star. It signals to everyone else, your investors, your suppliers, that you're a safe bet. So it's a great theory. It makes a lot of sense. But does it actually hold up in the real world? To figure that out, the researcher behind this study, Edgar Tovar-García, found the perfect place to test it: the Mexican banking system. Now, why Mexico? Because its recent banking history has been an absolute roller coaster. I mean, the government took over the banks, then sold them back, then watched them completely collapse in a huge crisis, and then had to bail them all out again. All this volatility means that everyone in Mexico, especially banks and borrowers, knows for a fact that banks can and absolutely do fail. The study zeroes in on a pretty recent time frame from 2008 to 2012. This is right after the global financial crisis, a time when bank stability was on everyone's mind. And it looked at data from 37 different banks, so we're talking about a really solid data set here to put this theory to the test. All right, so the stage is set. We have this cool theory, we have the perfect test case. So what did the evidence show? Were Mexican borrowers actually disciplining their banks? And the answer from the study was a resounding yes. It found direct evidence of this hidden market discipline. And it all worked through something called a price-based mechanism. So what on earth does that mean in simple terms? It means that borrowers in Mexico were actually willing to pay more for their loans. Yep, you heard that right. They paid higher interest rates just to get a loan from a bank they thought was safer, more stable, and more reputable. They were literally paying a premium for quality. And when you look at the data, the pattern is crystal clear. If a bank had more cash on hand, if it was bigger, if it had more reserves set aside for bad loans, or if it had fewer bad loans on its books, in every single case, borrowers paid a higher interest rate to do business with them. Each of these things is a clear sign of a high-quality bank, which backs up both of those motives we talked about earlier.
But, and this is where it gets really, really interesting, this hidden force wasn't everywhere. The study found two specific corners of the market where this effect just, poof, vanished.
So who were they? First, among Mexico's 7 biggest banks, the G7, the effect was gone. It seems like borrowers just saw them all as being in the same top league. They didn't really distinguish between them. And second, it didn't apply to retail banks, the ones that focus on everyday consumer loans. For the average person taking out a car loan or a personal loan, these high-level signals of bank health just didn't seem to be part of the decision. Okay, so what's the takeaway from all this? Let's zoom out and look at the bigger picture and what this really means for all of us. First, and this is the big one, A bank's own borrowers can be a seriously powerful force for stability. This asset-side discipline gives banks a real financial reason to play it safe, to be well capitalized, and to manage their risks well. But, and this is critical, it only works if borrowers can get good, clear information. And finally, it looks like this hidden force is most powerful not at the very top or in the consumer space, but in that competitive middle ground of commercial banking. So here's the bottom line. Making information about a bank's health public isn't just for the regulators or for us depositors nervously checking our accounts. It empowers a whole other group, the borrowers, to become another critical line of defense. And that helps create a healthier, more stable banking system for absolutely everyone. And that kind of leaves us with one last question to think about. If just making information public can unlock this powerful hidden force, it really makes you wonder, doesn't it? What other positive market forces are just lying there, dormant, waiting for a little bit of transparency to bring them into the light?